Here we go. This is the concept of depreciation. So plant, property, equipment which are fixed assets are known as tangible assets, and that are held for use in production for supply of goods and services, for rental to other, or for administrative purposes, and that are expected to be used during more than a period of 12 months. Then comes to the meaning of depreciation. So depreciation is a systematic allocation of depreciable amount of fixed asset over its useful life. So the depreciation charge for every period should be recognized in income statement unless it is included in carrying amount of any other assets. Now comes to the objectives of depreciation. So objectives are to ascertain the true profit, presentation of financial position, then replacement, no desertion of divisible profit. Then comes to the how many methods of depreciation are there. So there are two types of depreciation: straight line method and written down method. First of all, the straight line method. The concept of straight line method assumes that as asset provides equal benefit throughout its useful life, the amount of depreciation remains constant every year. The formula of depreciation is annual depreciation equal to cost price of asset minus scrap value whole divided by estimated life of asset. Okay, now comes to the example of this straight line method. Here is the question. The question is, on 1st January 2020, machinery was purchased by X for 50,000. On 1st July 2021, additional were made to the extent of 10,000, and then on 1st April 2022, further additional were made on the extent of 6,400. On 30 June 2023, machinery, the original value of which was 8,000 on 1st January 2020 was sold for 6,000. Depreciation is charged 10% per annum on original cost. Show the machinery account for the year from 2020 to 2023 in the books of X. X closed his books on 31st December. Here is the solution of this question. First of all, here it is machinery purchase 50,000. So we have to record to bank on debit column